All right, welcome back to the Hito LLC podcast. This is exciting time. We're now in December right now, and so this is the Super Bowl of tax planning. Got to get everything in, and this is crunch time. How are things looking for you, Yuko? Are you feeling the weight, the pressure?
Not yet. We just finished. We just finished all the annual business review with like our clients, so I feel like we are in a good place right
Yeah,
now.
and I guess this is fair, right? This is a business owner's last chance to really do kind of any kind of big movement that they're going to do, and then it really falls into a tax preparation schedule there. All of your CPAs can't breathe or can't talk for 3 or 4 months.
Yeah, but it's amazing that we do the ABR like every single year with our clients, and like we have there was something left with like their CPAs, and like we follow up, and like they're like, oh, we haven't talked to them yet, and like we're like, okay, go back and talk to your CPA now before like they get busy again.
Oh, that's intense.
Yeah.
Okay. And ABRs, the annual business review, you do ABRs with your clients obviously once a year. You also said you do QBRs? How does that roll up?
Some of them, majority of our clients, like we only do like tax credit, tax incentives, right? So, growing company and they have like more event coming up, like we do like sometime QBR, but majority of the time, we have been in communication for about 4 to 6 months during the project. So we talk to them like all the time. So at the end of the year, we do ABR with the most of the clients, but it's really depends, what size of company, what we are doing for them.
Got it. Got it. And just out of curiosity, this has been a up or down, like a very surprising, odd year for most people. One big beautiful bill, tariffs. It feels like in some industries, the economy and the economic outlook is just dragging along the bottom. Other people are having banner years. I'm curious to know, just from your perspective, has this year been surprising? Has it been surprising for your clients? What have their reactions been?
I feel like everybody is talking about emotional up and down, like as you said, right? Like starting from tariff, worrying about that, and then OBBB, are they gonna pass OBBB, and when are they gonna pass it? Once like they pass, there was a huge changes. So like even now, I feel like speaking to our clients at the ABR, like they're still unsure how to go about whether amending or like are they accelerating 174 capitalization. Like they still haven't made concrete decision yet. Like probably I would say like more than half of them. So
I
I feel
see.
like there's still like uncertainty. I feel like, and like people like still try to figure out like what they need to do.
And so we're kind of in the final hour of the year. This is the last month of the year. What should I be thinking about as a business owner to maximize tax planning, tax savings? I know personally for me, I have a big meeting with my CPA next Friday, meeting on Friday. I had a meeting with my bank. We kind of went through the financial projections and the plan. Like, as a business owner, what should I be thinking about to close out this year?
I think you're good. You are like head start by everybody else. Like I think I've heard this like couple times. Like they don't even have like financial, or they're not even close to start to close 2025 books. So if you don't even have a handle on financial book, like that would be a starting point, right? Without like CPA or like financial advisor, they cannot do planning based on a guess. So
Yeah.
we have to have good number. So that would be starting point, I would
Make
say.
sure your books are closed. It is amazing how many organizations don't, for whatever reason. Accounting's complex. They do, or they just ignore it until the back half of the year and do this monster project to catch up. And then wherever they land, they land. I mean, I remember in the beginning days of paper of my company, of like just handing this big stack of paper over to my CPA going, good luck with this. And luckily I've gotten out of that and have a great CPA relationship and a good bookkeeping relationship and close my books out on a monthly basis. But if you don't have your books closed, it's hard to do tax planning because no one knows what to look at.
Yeah. Yeah. Like even like if you're not closing every single month, like CPA won't know what to do with that. Like
you're sort of left with this big surprise at the end of that. All right. And I guess maybe that's the big takeaway. If you're just constantly surprised at what your tax bill is, maybe that's step one is go figure out a system so that you're not surprised at what this looks like. I remember I look over to my right, you can see I have books all behind me. One of the big aha moments for me in my sort of early days is Profit First, and just setting up a decent structure to make sure that there's no big surprises that go along with this.
Yeah, I love that book.
What else besides making sure your books are closed and you have a good plan in place and a good team that's behind that? What else should I be thinking about?
Yeah, whenever you're sitting down with like your CPA, like, you might want to talk about Section 174 deduction, 179 deduction, I'm sorry. And like, that would be expensing like, any fixed asset you purchase like during the year, right? And then bonus depreciation, those are two big changes like under like
And
OBBA.
that's buying a new car, buying equipment that fits into that category. If you're going to invest in new equipment or build out. Okay.
Anything like fixed asset and like, if you're in a manufacturing asset heavy companies, like that's something like, definitely talking about like, your CPA with.
I got it. So yeah, the OBB makes this a little bit more complex because the dates matter, right? Give us a little more clarity around when and how, or is that just to have that conversation with your CPA? Are there specific, like buying them pre-20, January, or what? Give me some more detail around that.
Yeah, so bonus 179, like there has been like, always been there. And like, the limit has been changed from like 24 and 25. 25 limit gonna be 2.5 million. For
Okay.
bonus depreciation, there was a phase out before OBBBA came in. So any purchase after January 19, 2025, if I remember correctly, like placed in service, that would be 100% bonus depreciation for 2025. So
Got it.
anything like, purchase and place in service before that, it does not fall in under like, OBBBA.
So 90% of this year counts, but if you were in that 20-day window before January 20th, 2025, then you're stuck with the old rules. Is that right?
Correct. Yeah.
Got it. Okay. So 179 is a big one. What else? How about retirement?
I think retirement plan is like, one thing you can do after the fact, like, tax year has closed. I'm touching like big things, right? Like there's a lot of things like you can do during the year to prepare for like tax returns, like August rule, like we talked about, home office deduction. Those are like, something you can do, like auto purchase, like, there's a lot of stuff you can do, but like retirement plans too, like, that's something you can do after the fact. So if you are projecting like big, tax bill, that's something like, you might want to talk to your CPA or financial advisor about.
Got it. Yeah. That makes sense. Yeah. Maxing out profit sharing in your 401k or maxing out your 401k, or even if that's a loan from your 401, there's plenty of things that you can do on playing with some of those structures to make sure that you're maximizing your
And
tax
beyond
plan.
the profit sharing, like, you may want to like, look into cash balance plan as well.
Okay. I don't know much about cash balance plan. We should talk about that later. You also have something down on your list that we had talked about, which is really interesting, is just making sure you're still in the right corporate structure, right?
Yeah.
And so this was interesting to me because I'm just in the set it and forget it mode. I hired a team to help me set up my company. And now that ship has sailed, all of that is done. You can change your corporate entity. I don't ever think about that. Tell me a little bit more. What does it matter in terms of a C corp versus an S corp versus, whatever?
Yeah, so these are not like service like I specialize in, but like, you probably want to talk to your CPAs, but like, depending on like what your trajectory or like what your plan in the future is, like there might be like, corporate changes like that might be like, best fit for you. And like, if you're in an S corporation, you might want to think about and make sure, are you taking like proper, like, W-2 income, right? If you're taking like a little too less, like, there might be audit risk, right? If you're paying like yourself too much W-2, you might be paying too much of payroll taxes. So there is a fine balance about like, okay, what's your market rate? Like, how like if you were to bring in somebody to replace you, like, what's the rate look like? And that's what, like, IRS will be looking at as far as, like, S Corp owners, like, compensation.
That's
If you're
great.
under C Corp, like, you might want to talk to your CPA about, like, balance between W-2, bonus, and the dividend, and how that going to affect your tax rate.
And most of this conversations is not something that Hito LLC does. This is something that your CPA does. Everything from corporate structure to maxing out your 401k or setting up that structure. These aren't these are things that you're doing to kind of put away the big fundamentals, and your CPA helps you with that. Let's get to some of the fun stuff that you do specifically that your CPA typically doesn't, which is federal incentives. And so let's start. I know we hit on this all the time with state by state, and we'll do that a little bit later as we get to New York. But let's start at the federal level and talk about incentives, money back to you. So tell me more. What should we be looking at from the R&D side, or let's just start with R&D.
Yeah. So maybe like before we start with the R&D, like maybe let's step back and like what kind of tax credit out there. So what's the tax credit? Like, what work opportunity tax credit is out there? Like if you are um, hiring like specific type of like, employees. So they might be like ex-veteran, like, low income, like, employees, um, long-term unemployment employees, or like, if you are hiring somebody like Native Indians, like you may qualify for like, what's called like work opportunity tax credits. There's like what's called like empowerment zone tax credit as well, and like there's fuel tax credits if you use like offload like vehicle in your premises and you fuel that. There's like fuel tax credits, and investment tax credit is like another big one which is phasing out. But there's so many like out there, so like I will highly recommend like if you're expecting like huge tax bill, like what did you do during like 2025, and can you like take advantage of like any of those tax credit as well in addition to R&D tax credit.
It's interesting. I have a lot of conversation and discipline around the personal side, and sometimes the personal side bleeds over into what you can do to maximize it by doing things in your company, 401k retirement plans, those sorts of things. This seems like a very deeper dive into the growth strategy of the business first that then impacts second. So I don't know if I've had these conversations with anyone other than you or somebody like you, where you're so focused on what is the business actually doing and how is it going to grow, whether it's a certain class of employee, where it's you put your headquarters, or where you invest in terms of R&D equipment, all those other things. And so that's where a lot of these sort of incentives, rebates, tax credits come into play that generates huge returns from the overall tax side,
Yeah.
right? Okay, so that's the big picture side of it. Where I think we've hit things like R&D, and like how do we break this down a little bit further?
Yeah. So like I'll talk about like R&D, like maybe like that would be probably like biggest like credits for a lot of like companies, like especially like a lot of people innovating, utilizing like AI and stuff like that. So research and development credit, like any company could qualify if you're like innovating and spending money and time on to like discovering new things, right? So what IRS said was like, if you're innovating, like we want to support your businesses, but you have to meet like 4 tests, right? First one is, are you creating or improving your product or process based on like, functionality, performance and stuff like that. And second and third one is like, if you're going to qualify as R&D activity, like onset of the R&D project, there must be uncertainty. And then to eliminate that uncertainty, like are you doing like formal, informal, like testing to eliminate those uncertainties? And fourth one is technology in nature. What that is saying is like any R&D activity like you're gonna claim like credit for must be rely on like hard science. So like math, computer science, engineering, and so forth. So anything around that, if you are doing like innovation, not just like creating software, you're not like everybody think about like these are like full large corporation or like, lab court setting or like, who is actually hiring like computer developer to like develop SaaS model. But it could be like, smaller company who are developing like, maybe medical device to computer internal like processing like automation like it could be anything around that. So really understanding like that full part test is like super important for you guys to identify what activity may qualify for R&D tax credits.
Got it. That makes sense. The R&D piece applies to so many more businesses than I was aware of, right? You don't just have to be in a medical or research sort of, that most organizations are spending time. It's just not normally a professional services organization like a marketing firm or a law firm. It has to be data driven, science driven on solving uncertainty in the market. So I love that. So that's at the federal side. What else is at the federal side? I know that there's some. You mentioned data centers. That's like everybody I talk to is talking about data centers, right? Like changes the valuation model on every commercial lease. Everybody wants to put money into data centers. I'm assuming that there's not just the data center component. There's also the energy side that goes along with that.
Yeah, I think like for federal side, like whenever people are talking about data center, like, they're often talking about like energy components, like green energy especially. And that's like, federal government like incentivize that. Like, if you fit into like ITC investment tax credit, that is phasing out end of like, 2025. And then like, it will phase out for like a couple more years. So depending on like where you are on a development and like implementation, like you may or may not be able to take credit for that. But if you're developing, I think like at least like you should talk to your CPA or expert about whether or not you can capture that.
Yeah. It's not just about getting it up and running better, faster than everybody else. It's about also capturing a lot of that tax revenue up front and planning through that process.
Yeah, and like just to add, like anything like you do like on a tax credit side, like this is like documentation heavy, so ITC as well. Like when it's like when you guys what is it, break the ground, that matters too, right? So all that documentation has to be like documented at the same time as like you are doing development. So if you're doing anything in that realm, like it's so important to like talk to expert. What do you guys need to document and like get that expert opinion.
Okay, love it. I guess the big prompt here is it's probably worth a conversation, not just with your CPA, but also someone like Hito LLC to pick up the phone and call and say, hey, what did you do in 2025? You've probably done a bunch of projects that may or may not qualify. Just assuming you may or may not qualify isn't assuming is a very bad thing to do in these sorts of situations. You could be leaving a lot of money on the table for this. And so as you're getting into December, it's probably worth a meaningful conversation to just lay out all of the things you did and maybe even have somebody pull those things out of you to see if you can capture any of that investment that you did on the tax side as well. Am I missing anything on the federal side?
No, I don't think so.
Okay.
Let's move on to state side.
We do the state side so often. It's so funny. We like move chunk by state. So this one was actually really surprising when you sent over some of the show notes that go along with this. I am so impressed with the state of New York. And so we're going to dive into New York specific state credits and just, I run a marketing agency. The marketing that New York has put into this is amazing. So let's jump into New York's tax credits specifically and just hit all of the branded names as we go along these projects because I think it's hilarious. So we've done the federal, and then we get into SALT, which is state and local credits. How is New York different than some of the other states that are out there?
I think New York, number one, their marketing is amazing.
Wasn't just me that noticed. All right, I love it. Good job, New York.
They have like a website called Choose New York instead of like EE like economic development entity. So they're spot on the marketing.
That's great.
Yeah, and as similar to like a lot of states, like, New York is like moving forward to like, hey, incentivize, like, somebody come forward and like, either creating job in New York or like retaining in a specific area or specific industry. So I think like, if you want to maximize like New York credits, you have to be like really forward thinking. Like if you're looking back, they're not going to incentivize you. But if you're looking forward and going to New York and saying, hey, we want to retain these like job instead of moving to like New Jersey across the bridge or water
River.
river, they might be like able to like give you like much more like incentive than like you can like say.
Got it. And I'm assuming we're like most people when we're thinking of New York are thinking Manhattan. I'm assuming these programs are beyond that. It's not just big high-rise office.
Yeah, definitely like in Manhattan as well. But like I think often I see is outside of Manhattan, people are like companies are uh, growing, like developing and retaining like those employees. Like that's where we get into like New York credits,
And that's manufacturing, medical, life
agricultural.
science, a lot of stuff in there.
Yes.
Love it. Okay. Let's jump into the first one. Once again, branded names. This is fun. The Excelsior Jobs Program.
Yeah. So Excelsior program is like combined with like five different refundable credits. So it is included like job tax credits, investment tax credit, and R&D tax credits, and real property tax credit, and child care service credit.
Oh,
And the
wow.
credit may vary depending on like size of company and like type of company, but and each type of credit has like different percentage. So I'm not gonna go over that detail, but those are like five big buckets of like credits that they are like available, but you have to be accepted into Excelsior program to be able to like get those credits. So just talking about like strategic industry is like scientific R&D, software development, manufacturing, agriculture, distribution, logistic, and life science. So those are like a big category like they're looking for currently. And like you have to like commit to like creating job or retaining job along with like creating like investment within the state of New York.
And is this a one-time credit or is this long period of time? I think that
Yeah, so
was,
go ahead.
yeah. What was interesting to me is that a lot of these were bigger, longer sort of investments, whereas we tend to think of credits as I hired them and now I get a credit back on my taxes. Um, there was some like this seems like a bigger investment on New York's perspective.
Yeah, so I just gonna talk about more generally, like because of like your question, like negotiated incentive tend to be longer time frame because you have to negotiate and like you have to commit to like multiple year contract, right, or milestone, and they will incentivize you like let's say some New York might be like 5-10 years, like California maybe like 5 years. So like if you get into those contracts, as long as you meet the milestone, they will incentivize you as long as that contract term is,
Got it.
right?
Okay.
But these negotiate like credit, like one thing like we have to be careful is there is a recapture provision. So if you don't meet those milestones, they might take away partial or all credit.
Got it. You have to hold up your end of the bargain
Yes.
and achieve that growth. I mean, like the specific industries, it was interesting the things that are incentivized here, right? The jobs, the investment, childcare, R&D, real property. These are all, they've kind of bundled all of the core elements of what it takes to build a healthy ecosystem for an employment base. I think that's it's more cohesive than we've seen other states do. It's always this like we're going to pick this one thing out of this one space, solar or wind or whatever it is. This feels far more comprehensive.
Yes and no. So other states have these type of program, but like they might be like called like different type of credits, and
I
usually
see.
whenever we negotiate, they will pull that together.
Got it. Okay.
Yeah.
Got it. So New York has at least bundled this all together into Excelsior to make it feel like a comprehensive package. You have to go hunt and dig for them in random places or disconnected places in other programs.
That's true. Yeah.
What should I be thinking about as a business to see if I qualify for Excelsior?
So one thing, you probably want to, as you have a strategic meeting internally, think about what is 3 to 5 year look like. If you're adding 5 to 10 people or more, you might want to start talking to somebody like us or your CPA and hey, here's our projection. This is our employee projection. There's capital expenditure projection, and start having that conversation and have them really make you understand what programs are out there. So when the time is right, you can go negotiate. And one thing I will tell everybody is those negotiations. Sometimes we get clients a month before they're starting to hire or they want to sign the lease agreement. But who we are negotiating with is government. So number one, we need to get information from you and create economic impact report or projection report. And then we have to go to state and negotiate those tax credit and share the information, and they're gonna be go back and forth. So allow CPA or expert to about 6 to 9 months prior to the investment, so that you can actually take advantage of bigger incentive like this, right? Refundable or bigger incentives.
Yeah, it's not just here's my lease, let's get moving.
It doesn't work that way, unfortunately.
I love it. I mean, it is a fair sort of assessment for New York or whoever to come alongside and say, hey, we want to co-invest with you. But in order to gauge the quality of our investment to it, if you're going to invest here, we'll invest here too. It does take some back and forth time to make sure that you're properly, evaluating that and structuring that in a way that makes sense for both parties.
Yeah.
Let's go to the next one, which is the Empire State Jobs Retention Program. This one's focused around a flood, right? That's a interesting one.
Flood or any emergency. So this is very similar to employee retention tax credit, if you remember during COVID in the federal side. So anytime the state governor announced emergency, so it could be storm, flood, or anything like that. New York has special program already set aside called Empire State Job Retention Program to make sure those facility or those company who were not able to operate to retain those jobs during restoration era.
Got it. So was there a flood this year? I don't think there was.
Yes.
There was.
I actually looked at it. In January, there was a big winter storm in New York. And then June and July timeframe, there was a flash flood in Long Island, Manhattan area. So they have announced emergency, application.
So if at some point you had a shutdown because of any sort of natural disaster, the first question you should be asking your CPA is, do we qualify for the Empire State National for the Disaster Fund? That's interesting. Okay. What's next on the list? We have alcoholic beverage production credit. This sounds like a fun one.
This one was fun one, and I debated whether or not include this, but as you know, I love drinking, so I had to put this in here.
So if you're a microbrewery,
or winery, or you're producing liquor, there might be production tax credit you may take advantage of in New York.
Okay.
Yeah.
So if you're doing beer, wine, or some sort of cocktails in New York, there's a rebate from the state of New York. That's amazing. Yeah. All the fun ones you find. All right, let's talk about life sciences.
So life science is this is a research and development tax credits, piggyback from federal R&D tax credits. But if you qualify as a life science company, the credit, state tax credit may be refundable. So that's something like, if you're in that life science, like, industry, you may want to take a look and like making sure that you can, like, you apply for like life science status and then take advantage of that.
And so most of these credits stack. So your goal is to find some of these credits and stack them up. Does this stack with the previous one that we talked about with Excelsior, or is this a replacement of that? Because I'm looking at the limits on these R&D credits, and they're significantly higher than the other one.
It should, like, it will stack, or like, typically how that works is like, same wages cannot use for like both of like R&D tax credit, right?
I
So
see.
if you're taking like, let's say you're like, well, you're taking 250K and you use like, 150K for like, total as like R&D like time, you have to bifurcate. So you cannot like use like, same ways to calculate different like credits.
You can't double dip on your time.
Correct.
That makes sense. Okay. Okay. So if you're in life sciences, there's a bigger R&D tax credit available to you. Let's talk about the New York investment tax credit.
So this one is investing in like, just qualifying property, like, building structure, machinery and equipment. There might be like, investment tax credits available. So like if you're in manufacturing, like, you want to take advantage of that and making sure that you are properly like, claiming that credit.
I see. So this is building structure, machinery, equipment, any of those sorts of things. Fishing is always in here for some reason.
Yes. I think like some reason like California too, like they love commercial fishing.
Coasts, I guess. All right, that makes sense.
Yeah. And I want to add one thing like before we move on to like next thing. I just like come across like potential clients like they calculated R&D tax credits for federal and states. They never claimed to own the tax return. The provider created like calculated R&D, but it never got on the tax return. Or for the previous year, they never filed like amended return. Even you're entitled to credits, you compute the credits. If it's not on your tax return, you are not taking advantage of it. So it's really important for like if you have like outside expert who is doing tax credit work and you have a CPA, make sure they communicate. And if you don't know what you're doing, just have them talk through so that you are actually taking advantage of like tax credits.
I would be so mad. It's amazing. And I wonder what that's true for me too. Like, it's amazing how much work we do that just doesn't make that final last mile, right? It just doesn't get on the tax return. And all of a sudden, this thing that you're leaving on the table doesn't impact your bottom line. I think it's worth a conversation just not to assume, like, you did all of that work. Did I actually get benefit from it? Having an external set of eyes, multiple sets of eyes that are looking that don't have those assumptions, that external objectivity to go, hey, you guys didn't do, of course we did a R&D tax credit. It's not on here. That would be a hard thing to hear. So I love this. We try to wrap up each of our podcasts, especially around states like this, with a very clear, actionable list. So if you're running a business in New York and we're now in December, what are the questions I should be asking my CPA, my CFO, my tax preparer? Give me the checklist of where I should start with. You already gave me a few. I wrote it down here on a Post-it note of things I need to follow up on.
So first, I will say, have an internal strategic meeting and be clear, like, where your action plan is or growth plan is, right? And then have CFO or like your controller, like, create like a meeting, annual business review with like CPA and like expert, like either separate or like together, and really talk through that and like, see what opportunities are out there. And I know everybody's looking back 2025 taxable year, but also think about 2026 tax year and like say, hey, as we are growing, like what can we do to like minimize taxes?
So build that 3-year plan, but spend some time to look back. So that client you mentioned that did all of the R&D tax credit, but it didn't make it on their tax return, is there ability to look back and refile some of those?
Yes, they were not their potential clients. So like,
don't go
it
too
was
far
great,
here.
but
So
it was great.
there is the
Yeah.
opportunity to then actually pull out paperwork from the previous 2 years and go, what am I missing here? I love that.
And just just to be clear, like some of the states, like a lot of credits are like forward looking. So if you haven't negotiated or if you haven't applied, they may not take a credits. But there is a lot of like opportunity to look back state tax credits and federal credit as well. So just don't like don't discount like look back opportunity as well.
Yeah, we get really geeky and start throwing out things like Section 179 or, all of these other provisions. But your job as a business owner or as someone leading an organization is not to know all of the options that are out there and the thousands of little credits that are available. It's to bring the team together and to say, hey, are we missing anything? What should we be qualifying for? What should we be thinking about? And know that there is a lot of support both at the local level, state level, and federal level to make sure that businesses like ours succeed and grow. And so as we're planning for growth, how do we bring in the rest of these incentives that should be coming our way for
Yeah.
doing this work?
Yeah.
I love
And I
that.
think like you said, like, previously, like, you have to stack up like, credits, right? Each one might be small, but like whenever you stack up all the credit, like it might be significant. So don't discount like, all of them and
I
like
see.
just take a look at like, at least like investigate.
Love it. Anything else?
Yeah. I don't know.
I think we hit it. I think we
Yeah,
nailed
I
it.
think so.
All right. Thank you, Yuko. It's always a joy to
Thank
talk to you. We'll
you,
we'll
Paul.
do the next state.